Good day, everyone. Allow me to introduce myself in a few words. My name is Thomas Grangeard. I come from France. I've been living in China for 12 years now. I came initially to complete my studies in economics and management at the University of International Business and Economics in Beijing. Once I graduated, I started an internship at Mazars in the financial audit department. After 6 months, I was hired as a member of the accounting and outsourcing services team. I have since been working in this service. I focus primarily on advising foreign investors with their operations in China, whether they have a direct presence via a company or representative office or without any legal presence at all. About 65% of our customers are European. The rest are American or Asian, mainly from Singapore, Hong Kong, or Japan. Our team focuses mainly on outsourced accounting and tax compliance, payroll, and also company secretarial services. Today, I'm going to be talking about accounting in China, and more particularly on the specificities of Chinese accounting, with a focus on the common issues that foreign investors may face that are unusual to them. So let's get right into it. To start with, I wanted to brief you on the statutory obligations for organizations in China, as well as summarizing a few general information. First, organization, whether a company, a representative office, or an NGO, are required to prepare, to maintain, and submit accounting records. By records are meant accounting vouchers, that includes all accounting entries, debit and credits, accounts books, including general ledger, sub-ledger, journals, and financial statements, balance sheet, income statement or profit and loss statement, and cash flow statement. I'll come back to the form these records must take a little later. A few general information you need to know about Chinese statutory records. In terms of standards, the accounts must be prepared in accordance with Chinese accounting standards, or CAS. I will be introducing in very general terms how these standards compare with international ones. The accounts must be prepared in Chinese. We will see later how this can impact your accounting or reporting system. The accounts must be prepared and reflected in Chinese yuan or renminbi. The fiscal year runs from January 1st to December 31st, and the accounts must be prepared and submitted to the tax authorities on a monthly basis if the enterprise is considered a general VAT payer, or on a quarterly basis if the organization is considered a small VAT payer. A short note on VAT, as I will not be getting into this today. There are two VAT status in China, small and general taxpayers. All companies are born small VAT payers. When a small VAT payer, the applicable rate is lower, usually 3% on sales, but the company does not have the ability to claim VAT input. That's the VAT from its purchases. VAT is therefore closer to being a sales tax than actual VAT as we know it in Europe. As a general taxpayer, a company will apply a higher VAT rate to its sales, generally 6% for services and 17% for trading of goods, but it will have the ability to claim back VAT input. I will not be spending too much time on Chinese accounting standards, as it can get fairly technical and it could take a lot of time. This is merely a simple, very general presentation of the standards applied in China. First, what you need to know is that the Chinese accounting standards were revised in 2006, so fairly recently. Before then, we used the old PRC gaps, which showed significant differences with international ones. The old PRC gaps had been thought of and introduced at a time where the economy was predominantly controlled by the state, with a private sector still relatively small in size. The revised CAS, introduced in 2006, were meant to better serve a modernized market economy with a stronger private sector. The CAS were, logically, substantially aligned with IFRS. Some of the key introductions that had an impact on foreign businesses included notably the accounting for share-based compensations. So that includes both stock options and restricted stocks. Before 2006, organizations did not have the ability to account for these items in their records. These items remained off balance sheet. Another key introduction was the recognition of deferred tax. So that's a small revolution that accountants still today have a difficult time to grasp. The accounting of deferred tax can have a significant impact on a company's balance sheet. I'll come back to that a little later, as it creates some issues with the local accountants. And the final point I wanted to mention was the generalization of the concept of fair value for non-monetary exchanges. One key point I want to emphasize when it comes to CES is that Chinese accounting should be prepared on an accrual basis. Again, this is a very important topic and a very common issue, so I will be coming back to this in more details. I mentioned that CES was significantly aligned with IFRS. Though that is true in most cases you will encounter, there remain some differences with IFRS that you need to be aware of. I have only listed the main ones here, but of course the list is not exhaustive. First, on asset evaluation. While in IFRS revaluation is permitted, CES does not allow it, similarly here to US GAAP actually. If a company possesses a fixed asset which fair market value has increased over time, IFRS allows an upward revaluation, which is not the case in CES, though the concept of fair value was generalized in 2006. On borrowing costs, so here what I mean by borrowing costs are debt interests and other financing charges. IFRS allows you to expense it through the income statement or capitalize it if certain criteria are met. Under CAS, borrowing costs have to be capitalized. The currency used to present the financial statements. In IFRS, the choice is left open. In CAS, it is also left open. It does not specify that Chinese currency should be used, but Chinese law requires the use of CNY. The presentation of the financial statements. In your IFRS income statement, expenses are analyzed by nature, traveling expenses, salaries, rent, etc., or by function, selling expenses, administrative expenses, financial expenses, etc. While in CES, expenses are analyzed by function only. I will present you a sample of a Chinese income statement, so you'll have an opportunity to see how this looks like. The final difference that I wanted to talk about today is the cash flow statement. In IFRS, both the direct and indirect methods are accepted, but the direct method is encouraged. In CAS, a cash flow needs to be prepared according to the direct method and a reconciliation of the operating activities using the indirect method. So here you will see a sample of a simplified balance sheet used for statutory reporting. You will find that it is probably very close to what you're using in your own businesses. The Chinese balance sheet has an assets and a liabilities and equity side. The assets are broken down into current assets, which include monetary assets, receivables, advances to suppliers, inventory. Fixed assets, so here CIP stands for construction in progress. Intangible assets like softwares, long-term deferred assets. The liabilities are broken down into current liabilities, which include short-term loans, payables, accrued payroll, advances to customers, and long-term liabilities, which include long-term loans and debts. The equity comprises capital, paid in capital, capital in surplus, retained earnings, that's the accumulation of past profits and losses, and legal reserves. The tax authorities require for the balance sheet to present both current data and a comparison with last year's figures, hence the two data columns N and N-1. Here you will find a sample of a simplified Chinese income statement. The logic is here again close to what you may see in your own businesses. The income statement rolls down from sales, deducting cost of sales and sales taxes, giving us the gross margin. Then deducting expenses, giving us the result before tax. Income tax then applies if a profit is generated. A couple of points here. You will note that the income statement separates revenue from main activities in line 1 and revenue from other activities. In China, a company is usually granted a very narrow and very limited business scope. Any activity outside of this business scope is considered illegal. So most companies therefore have very limited use of this revenue for other activities. But it can be the case if a company has obtained a larger business scope with multiple activities. In that case, segregating revenue lines is important. You will also note the three functional expense categories that I have mentioned earlier. Operating expenses, usually used to report expenses generated by the teams directly involved in production or sales. General and administrative expenses, that's the G&A expenses line, used to report administrative, support, and management expenses. And financial expenses, used to report any bank charges, interests, foreign exchange gains or losses. The non-operating line differs from the other two revenue lines I mentioned before, simply because it is used to report income not generated by operations. To give you a few examples, this is used in cases where a court ordered indemnities to the company or tax reimbursements. Now I wanted to spend a little bit of time on the accounting software organizations use in China, as there are some specific requirements here. To be used for the preparation of statutory records, the software needs to meet a number of requirements listed by the tax authorities. These requirements include an unlimited and unrestricted access from within China. For those of you who have traveled to China before, you will be aware of the Great Firewall that controls internet access in the country. Accessing certain websites hosted outside of China and or servers located outside of China can be difficult and slow at times. In certain cases, access can be completely blocked. If you wish your organization in China to use the same system as the rest of the group, a quick accessibility test is needed before launching the project. The system also needs to have a user interface in Chinese. The logic here is simple. In case of an inspection from the authorities, agents need to be able to navigate the system easily. The user interface needs to be in Chinese. The system needs to support Chinese characters input. Because your accounting needs to be prepared in Chinese, your accountant needs to be able to input descriptions, account names, etc. in Chinese. The system needs to support the Chinese chart of accounts, and it needs to be able to produce financial statements in the format I presented earlier. These requirements are of course only applicable if you wish to use your group accounting system in China for statutory accounting purposes. If you use two different systems, a local one for statutory purposes, and a group's one for management purposes, then there is no problem. I want to emphasize on the fact that while it is of course possible to implement the group's accounting system in China, either by purchasing a China patch from the developer, SAP, NetSuite, and many others propose these services, or by developing it on your own, this can prove to be a very long and costly project. I do not recommend small businesses go there, at least not until operations have picked up and the company has resources to allocate on such a project. Hard copies. This is probably what will appear to you as the most time-consuming and low-value aspect of your accounting in China. The authorities require for hard copies of the accounting records to be prepared, classified, and archived. This includes accounting vouchers, which should be printed one by one and attached to original supporting documents, such as invoices, goods delivery notes, banking slips, etc. One of the reasons for hard copies to be required is the use of tax invoices. Again, if you have visited China, you may already be familiar with the concept, but I will come back to this shortly. Here is an example of what a hard copies would look like. You can see that vouchers of the month are attached and bound together. This is prepared as required by the tax authorities. Here, an example of an accounting voucher, when you can clearly see the entry with its debit and credit size. The voucher needs to present on the top left the period, on the top right the voucher number. The left column is then used for descriptions, here an employee's claim for advanced payment. The large column to the right presents the account number and account name, in this case G&A expenses, of a payable due to staff, and cash on hand. The two columns to the right hand side are the debit and credit with figures. The bottom of the voucher needs to present, among other things, the total debit and credit, the accountant's name, so the accountant that inputs the entry in the system, and the reviewer's approver's name. This needs to be printed for each accounting entry made. Of course, your system would ideally be able to generate vouchers in this format. Here an example of the supporting documentation required for that same entry. Here, a cash out request, as the employee was repaid through cash on hand kept at the office. On the bottom, a tax invoice to support the purchase, in this case coffee beans for the office's machine. These supporting documents need to be attached to the accounting voucher. Altogether, the month accounting vouchers plus supporting documents gives the hard copies pack that we have seen in the first slide. They need to be bound together once a month is closed. Now, these accounting records need to be archived. The retention period was recently extended. Here you will find the requirement for each category of items. I will emphasize on a few. Original vouchers and bookkeeping vouchers, like the ones we've just seen, need to be kept for 30 years. Now, 30 years is usually the duration of the business license granted by the authorities to foreign invested businesses. So it basically means for the entire duration of the company's lifetime. Same retention requirement for accounts books, general ledger, sub-ledger, journals. Please note also that annual reports submitted for the annual income tax filing, list of retained and destroyed records need to be retained permanently. This includes the situation where a foreign investor would disengage from any structures in China. If, for instance, you liquidate your company in China, you are still required to permanently retain those reports. Tax invoices. Tax invoices are called fapiao in Chinese. They consist of pre-printed invoices companies can purchase from the tax authorities. So the tax authorities pre-print those invoices and then the company can purchase those pre-printed invoices from them. In principle, a company is required to issue a tax invoice whenever it generates revenue. This is the way used by tax authorities to ensure that applicable taxes are levied appropriately. Tax invoices come in different forms depending on the nature of the transaction, the status, the VAT status of the issuing taxpayer, and the location. Here you have a sample of a tax invoice issued by the company managing the highway near Shanghai. You will note that the tax invoice carries the seal of the tax bureau which printed the invoice on top. That's the red oval-shaped stamp on the top, as well as the seal of the issuing taxpayer. That's the one on the bottom, the one that's fairly bigger. The invoice number, anyone needs to be able to check online if a tax invoice is genuine or not. So that's the big number in red in the center of the invoice. And the tax invoice also needs to show, of course, the value, in this case 5 RMB, written in Chinese characters. That's the one circled in light blue. This is a sample of a printed invoice with a nominal value, that's a fixed amount, typically used in public transportation, subway, bus, toll gates, which means that here, basically, the invoice you're seeing is the invoice that the company purchased from the tax authorities. It did not need to print any additional information on it. Another sample of a tax invoice. Here, an invoice where the taxpayer will actually need to print out details of the transaction. So areas pre-printed by the tax authorities in red, and areas filled in and printed by the issuing taxpayer, blank here. This is the kind of tax invoice your business in China will most likely be issuing to its customers. On top, you will notice that the tax bureau seal shows up again. This is standard, as well as the invoice number on the top right in blue writing. A difference with the previous sample is here the customer information. That's the big white square on the top left, where the issuing taxpayer will need to indicate its customer's name, that's the full company name, the VAT number, the address and telephone number, and the customer's bank name and account number. So this is a lot of information. This information needs to be collected from your customers, and it needs to be correct in order to issue a tax invoice. I want to emphasize here, any mistake on the fapiao, whether it is on the name of the customer or its bank account number, is the responsibility of the issuing party. So if you issue a tax invoice, send it to your customer, who then finds that there's a mistake with it, it is your responsibility to reissue that invoice and to go along all the procedures with the tax authorities that are needed. Then, of course, you will find the details related to the transaction. So that's the center table of the tax invoice, which includes on the left the description of goods or services. The amounts, of course, are presented, the unit price, the quantity, total price, applicable VAT rate, and total due inclusive of taxes. And of course, at the bottom, the issuing taxpayer information, same as for the customer, name, VAT number, address and telephone number, bank name and account number, and the issuing taxpayer's seal in the bottom right of the tax invoice. This type of invoices is issued using a specific software and printer that companies need to purchase from the official suppliers designated by the tax authorities. The computer used for printing invoices needs to be connected, of course, to the printer, but also to the central tax system via the internet. The idea here being that the tax authorities will know as soon as an invoice is issued At the end of the month, a reconciliation between the invoices issued, the information they collected in their system, and the VAT filing is being done. Any inconsistency results in the invoice system being frozen, so the inability to issue invoices to customers, and 2, an inspection. Now, a fair warning here, because issuing an invoice triggers taxation, certain companies are reluctant to issue a tax invoice prior to collecting payment from customers. And because the tax authorities will look for consistency between the invoices issued and the financial statements submitted when filing tax returns, the accountants are often delaying sales recognition in the statutory accounts. This creates a cut-off issue in the accounting, which of course contravenes the rules laid out by the CAS as well as by Chinese tax law. This of course works as well with expenses. Accountants can be reluctant to record an expense until the tax invoice has been collected from the vendor. The reasons here being tax related to expenses that are not supported by a tax invoice are considered non-deductible before income tax. Needless to say that this situation also contravenes Chinese accounting standards. Audits. Foreign invested companies, whether they are fully owned by a foreign investor or partially owned in a Sino-foreign joint venture, and representative offices are required to submit their statutory financial statements to an external audit. The audit is being carried out by a Chinese accredited CPA. The CPA issues an audit report, will follow a standard format, and comprises the emission of an opinion, so similarly to what we see back in Europe. The report presents audited financial statements, balance sheet, income statement, and cash flow statements, as well as accompanying notes. The report must be issued in Chinese. Now, in certain cases, on top of this statutory audit, a tax audit may be required. Here, the audit is being carried out by a CTA, that's Certified Tax Agent, who will be primarily focusing on income tax and notably on the calculation of the tax result. That's the calculation where the tax agent basically removes all non-deductible expenses. The audit reports are required by the Administration of Industry and Commerce, AIC, for the purpose of the annual inspection. The deadline is June 30 of the following year. The AIC is the administration which issues the business license. The National Tax Bureau also requires the audit report for the purpose of the annual income tax filing. The deadline here being May 31st of the following year. Logically, the audits take place between January and March of the following year, depending on group deadlines. Because it is obviously the purpose of every business to generate profits and distribute them to investors, I wanted to take some time to mention the legal requirements and accounting mechanism that surrounds such a situation. On the legal requirements first, a profitable enterprise is required to allocate at least 10% of its distributable profits to a general reserve fund, also known as legal reserve, before it can pay dividends to investors. In the accounts, this reserve constitutes merely an accrual on the balance sheet. The company can, of course, access these funds and use them freely in whichever way it seems fit to remunerate employees, purchase services or goods, etc. So it's just an accrual in the accounting books. Once the cumulative reserve fund reaches 50% of the registered capital, the board of directors or the executive director, depending on the governance established by the Articles of Association of the company, can opt to halt these contributions. There are other reserve funds that exists, notably the Bonus and Welfare Fund or the Enterprise Development Fund, but contributing to these is at the discretion of the Board of Directors of the company. I prepared here an illustration to present concretely how all of this works. You have here a company which has recorded losses in 2011 and 2012. The accumulated loss end of 2012 amounted to 2.7 million RMB. Starting 2013, the company generated profits. You will notice that income tax was not levied from that year because a company can carry forward for 5 years its losses. 2013, 14, and 15 profits were used to absorb the previous losses. In 2016, the profit generated that year finished to absorb the accumulated loss and created an accumulated profit. Income tax was levied. The general rate is 25% in China. There are of course situations where lower tax rates apply, but just for the purpose of this illustration, I've taken the general rate of 25%. After deducting the income tax due, the profit after tax, also known as distributable profit, amounted to 2.65 million RMB. This is when the general reserve is being accrued at a rate of 10%. Before paying out dividend, the company is also required to withhold income tax due on the China-sourced dividend. The applicable rate varies depending on the bilateral tax agreement or double taxation agreement signed between China and the investor's country. The generally applied rate is 10%, so I've used that for our example. I invite you to, before investing into China, to take a look at these double tax treaties that have been signed with China in order to assess all the rates that would be applicable on dividends, but also on any other taxes that can be levied on the investor in China. After withholding the income tax, the amount of dividend can be remitted to the investors. In the second part of this presentation, I wanted to list some of the issues my clients and more generally foreign investors are confronted with when working in China. These are very concrete examples that you may face. As such, I also wanted to seize this opportunity to share some advice on how to best treat each situation, in my humble opinion. The first issue I want to comment is the one of cash-based accounting versus accrual-based accounting. As mentioned earlier, the Chinese accounting standards are on this topic very clear. Statutory accounting should be prepared on an accrual basis. Accountants in China do not generally disagree on the principle, but can often, knowingly or unknowingly, not be respecting this principle. I listed here some of the reasons. First, the information is simply not transmitted to the accountant. That's a very common issue for startups where processes have not yet matured and owners have usually concentrated more on the business and operation aspects than on the administrative support. Another reason can be delaying taxation, also very common with startups and small-sized businesses that may face at times cash shortages. This creates, of course, distortions in the accounts, notably on the sales, cost of sales, inventory, and expenses accounts, with a real impact at the end on the presentation of the performance of the company. Another concern being obviously compliance in a country where foreign invested companies, I wish to remind you of that, are being audited comes year end. My advice on the matter is, first, management needs to reaffirm the principle in its accounting policies. Second, implementing the proper processes and the proper channels of communication to ensure the accounting team receives the necessary, complete information needed to prepare the accounts. The second common issue might raise a few eyebrows, so much it sounds unlikely to happen. Believe me though when I say that it happens very, very often, unfortunately, in China, in particular among SMEs or Chinese companies. It is not uncommon to find companies with multiple sets of accounting records, each of course showing differences with the others, as they were prepared with a different agenda in mind. Typically, in such situation, you may have statutory accounts, those filed with the tax authorities. Statutory accounts are generally reported figures aiming at lowering or delaying taxation. You may also find, in some cases, an investor reporting. This is the one communicated only to potential investors. As you can imagine, the figures presented there are somewhat embellished to attract investors or raise the value of the company. The concerns in such situation are here again compliance, obviously transparency, and again it complicates the reading of the true performance of the company. My recommendations here are simple and pragmatic. Similarly to the common issue we mentioned before, management needs to reaffirm its position through accounting policies. Second, differences between statutory accounts prepared in accordance with Chinese standards and management reporting to the group that can be prepared in accordance with group standards, IFRS or local GAAPs, are acceptable as long as they are documented and tracked through a transition table. Common issue number 3 concerns all foreign invested enterprises in China. Here's why. To incorporate a business, a foreign investor will be required to rent an office space in China. Now, this may sound absurd, but it is the case. A company that does not exist yet must have a dedicated office space already rented out. This is of course only one example of pre-operating expenses an investor will need to advance before incorporating a business. Other examples may include salaries if you already have employees or individual contractors on the ground working. Consultancy fee can also constitute pre-operating expenses. The problem here is that the newly established subsidiary will not be able to reimburse these expenses advanced by the group, even when it is incorporated and fully operational and it has the necessary funds to settle the debt. The reason being foreign exchange controls. Now, I want to take again here a little bit of time to explain this further, as it may sound very exotic, and especially for Eurozone businesses. The RMB remains today a semi-convertible currency. This means that it is convertible into foreign currency, but its convertibility is conditioned to a number of rules. These rules are being enacted and enforced by an administration, ironically called SAFE. SAFE stands for State Administration of Foreign Exchange. This administration oversees all cross-border transactions, and you will be inevitably confronted to it when doing business in China. You will face it when you want to inject capital funds into your subsidiary. You will face it when you want to receive payments from customers based in China, because this administration oversees truly all cross-border transactions. In the case of pre-operating expenses, SAFE considers them as an unregistered foreign loan and as such refuses its repayment. Beyond the investor's obvious concern of getting paid, this also creates concerns for the subsidiary. First, it presents a debt in its balance sheet that may very well remain indefinitely in the balance sheet. Second, In case the debt were to be waived at one point of time, which, by the way, is the logical conclusion of this issue, the waived debt constitutes a taxable profit. My recommendation, and I know investors do not like to hear this, is, I'm afraid, decide not to recharge these expenses to the newly established subsidiary and bear the cost at group level as part of the initial investment. Another common issue I wish to raise your attention to is the failure of accounting for deferred taxes, though prescribed by Chinese standards. This can particularly affect the financial statements of newly established companies which have yet to break even, much like the illustration previously used when presenting the General Reserve Fund. The reasons usually are a lack of familiarity with the concept, though this is less and less true as younger accountants are being prepped for this type of situations at university. Second is small businesses may not have dedicated tax team within their finance team. Accountants often believe it is not of their responsibility to calculate a deferred tax. The third main reason is simply omission, because management, auditors, or tax authorities are not pressing on this, so the accountant does not really believe it is important. In any case, this raises concerns in terms of completeness of the accounts. My recommendation here is, one, to train your accountant so that he or she is well aware of the need to account for deferred taxes and also knows how to calculate it. Two, involve your accountant when drafting forecasts, or at least inform him or her of the company's forecasts, as this directly impacts the recording of deferred tax. I seize this opportunity to remind you here the principle: a deferred tax asset should be recorded if it is deemed more likely than not that the asset will be used in future fiscal periods. The next common issue I want to present is the failure to calculate tax adjustments. At year end, when the accounting result is known, the finance team is usually required to calculate the tax adjustment used to remove all non-deductible items to obtain the tax result. Because an audit is performed on the annual financial statements, accountants, especially those who do not have a tax team working with them, have often delegated this task to auditors. Now, first, this obviously is not the role of the auditor, and second, this results with an audit adjustment and additional income tax to be declared and paid during the annual filing. The reasons here are a lack of familiarity with the tax regulations, no team dedicated to taxes, or again, an omission. Not very likely, though, if the accountant has experience, as this happens every year. The concern for management is, first, an under-accrued tax liability in the accounts, and for certain investors, a surprise additional tax cost several months after the year-end closing. My recommendation here is to reaffirm management's decision to have this calculated and accrued for in the account comes year-end, and to train your accountant in case you do not have a dedicated tax team. An issue that trading or manufacturing companies often face concerns inventory. I often witness improper accounting of inventory, in particular affecting work in process and finished goods. The reasons here are multiple: information not properly transmitted to the accounting team, a lack of an integrated information system, miscommunication between the production and the accounting teams, or simply a lack of understanding of the production cycle by the accountant. This creates concerns in terms of, well, one, accuracy of the accounts, and two, cutoff on cost of sales with an escalating effect on the margin and the profit of the company. My recommendations here are either to implement an ERP system or implement proper inventory follow-up with procedures to ensure it is consistently prepared and consistently communicated to and understood by the accounting team. And of course, encourage communication between departments. Another issue commonly seen is the failure to account for impairment on creditors or inventory. The teams responsible for managing the client relationship or the one responsible for inventory may be aware of the loss but fail to communicate it to the accounting team. There may also be situations where the accounting of the impairment was not done because the approval from tax authorities for tax deductions was not obtained. This affects the accuracy of the accounts. It calls, of course, for the implementation of proper communication channels across departments so that the information is brought up to the accounting team. A recommendation is also to ensure all necessary procedures with the tax authorities are handled so as to enjoy tax deductions. This starts with training your accounting team, who may often not be aware of such requirements. The last common issue I want to share with you concerns assets depreciation. Chinese accounting standards grant organizations the freedom to choose their depreciation policy as long as it is economically justified. Accountants, though, can be tempted to align depreciation policies with tax rules so as to minimize the tax adjustment comes year end. The issue being that at times the tax rules may differ from the most economic reality of the company. This can be seen with the sometimes unjustified use of a residual value and or depreciation periods. This of course affects the accuracy of the accounts. My recommendation here is to formalize the accounting policies you wish to see implemented and ensure they are being followed. In conclusion, I would like to once again emphasize on the fact that Chinese accounting standards are very similar to international ones. But because one, the convergence of principles is relatively recent, and two, the general practices have yet to adjust, old habits die hard, you may need to spend time with your accountant to ensure good practices are implemented and followed. China presents a number of particularities. We mentioned these before: hard copies for accounting, tax invoices, foreign exchange controls, difference between accounting and tax rules. Because of this situation, you may need to spend some time with your accountant to also understand the complexities he or she is facing. For those of you in particular that may consider partnering up with a Chinese investor on a venture, please remember that accounting is not only about compliance, but also ultimately about control. Whoever supervises the accounting, and more broadly the finance department, gains considerable control over the enterprise. A newly established organization does not have the same level of maturity as its European head office. It is therefore essential to write down and explain key processes and controls you want to see implemented. It is also important to remember that trainings need to be done. And again, regular controls need to be made to make sure that rules are followed as you want them to be. Finally, I'd like to remind you that China is still a very much developing country, though when visiting Beijing and Shanghai you will not find it this way. The rest of the country is still catching up. The economy is still strongly piloted by the government, and therefore reforms are often implemented. Now, the speed at which reforms are implemented in China is somewhat not what we are used to in Europe. So rules change all the times. It is important that you keep aware of the rules that may affect your organization. That's a general recommendation, but also the ones that may affect your accounting and your taxation. That's all for me today. If you have Q&A, please send them through. I'll be happy to answer the questions. Thank you very much. Have a nice day.